Hello, in this video we'll be talking about stock sales. Corporations can sell stock as a means of raising capital or money for their company. There are different classes of stock that are available, but when we're talking about common stock or common shares, those two terms are interchangeable, then the individual or entity that purchases that stock has a small piece of ownership in that company. For when we're talking about stock, there's different classes of stock, but you'll also see different things such as we have what's called par value, no par value, or stated value on the different types of stock, whether we're talking about common stock or preferred stock. Just know that par value is it's really an arbitrary amount that is assigned to each share of stock when it's authorized. And it's authorized when the company first formed and it's in the company's articles of incorporation. Par value is absolutely not the market price or the value of the share. Okay, it's really an arbitrary amount. And really what we have to know about it is that if a stock has a par value stated, then just the way we record it would be different than if it had no par value. I've put in a snapshot of Meta, its latest 10K filing, and I wanted to focus kind of right here on the stockholders equity section, and it lists out these common stock, right? And so look at it says common stock, and it's point, and then there's 5 zeros and $6 par value, right? So it's a very nominal amount for the par value. 5 million Class A shares authorized. So in its articles of incorporation, it probably had 5 million shares authorized. And in this is talking about December 31 to 2025 and 2024. So in 2025, it had 2.187 million shares that are issued and outstanding. So meaning this is the number of shares out there in the open market. This is 2.1 billion shares. And look at here when it has the value for it on December 31, 12th. This is December 2025. You just can't see it. It has 0. And that's because I took this 2.1 billion times this par value, and it ended up being $13,000, which because this 10K is in millions, they show it as a 0. But you can see that it's such a nominal amount, it doesn't even appear on their schedule. And the remaining portion, when they do record a sale of stock, goes to additional paid-in capital. But I just kind of want to show you just how nominal of a value the par value can be, and it really is absolutely not the market value of a stock. So let's take an example of when we just sell shares of stock for cash. Dow Industrial sells $10 million of its common shares, $1 par per share, for $10 per share. So we record the cash, so we debit cash for the full amount, right? So we got 10 million shares and we sold it for $10, so that's $100 million. So debit 100. Then we have to credit the common stock account and the paid-in capital excess of par account. So the common stock account, all you do is you take the number of shares multiplied by the par value. Okay, so in this case it's 10 million times a dollar, so it's $10 million. And then the rest just goes to this account called paid-in capital excess of par. And when we go to the Meta one, that's this account. When it says additional paid-in capital, all their paid-in capital, because there's various ones that are used for different entries, are all grouped into this one row on the 10K. But in any case, the paid-in capital in excess of par is just the plug. It's just the remaining number. It's the $10 million shares multiplied by any amount that they received above par, which it means $9 per share. So they have $90 million credit. Now, if a company has no par value, which is also standard, then you just do your debit cash for 100 million and the full 100 million goes to the common stock account. There is no paid-in capital in excess of par. There's also situations when shares are sold for non-cash consideration. So a company could use their shares to pay for legal services or some other services, or they could also sell their shares to purchase something, whether it's equipment or land or some other non-cash asset. Now, how should that transaction be recorded? Well, if we know the value of the shares at the time that we granted them, then we're going to record them at that value. So let's go, and this is consistent with how we do employee share-based payments, which is in a different chapter in the book. So let's go through an example. DuPont Chemicals issues 1 million of its common shares, $1 par per share, in exchange for a custom-built factory for which no cash price is available. Today's issue of the Wall Street Journal lists DuPont stock at $10 per share. So they issued 1 million of their shares for this factory, right? They don't know the fair value of the factory, but they do know that the value of their shares is $10, so that's the value we assign to that factory, the property, plant, equipment. So we're going to take the $10 per share multiplied by a million shares, and we're going to assign that to property, plant, and equipment for $10 million. And then our common stock, we're going to have to credit. So when we issue common stock, it's a credit balance because it's a shareholder equity balance. And account, and we're going to take the number of shares that we issued, and when we say issued, it means sold, the number of shares multiplied by their par value. So in this situation, it's credit $1 million, and then the rest goes to paid-in capital in excess of par for $9 million. Oftentimes, when companies use their stock to purchase, whether it's services or land or non-cash asset, they might issue more than one type of security for that item. So meaning like they might issue common stock and preferred stock. So, or they might say, oh, here's common stock class A, and we have common stock class B shares that we're going to issue you for this one piece of land or whatever it is. So two things can happen. If the cash received is the sum of the separate market values of the two securities, then each is recorded to market value. So if we purchase land for this two classes of common stock, class A and class B, and we know that class A is worth, $5 million and class B is worth $6 million, and we paid $11 million for this land, then we would record, that we issued class A stock for $5 million and class B stock for $6 million. Or if only one security's value is known, then the second security market's value is inferred from the total. So if we sell land, right, for $11 million and we issued common stock and preferred stock, but we only know the market value of the preferred stock, right? So let's just say the preferred stock is, the common stock is 7 million and we paid a total of 11, then we would just assign 4 million, the remainder, to the preferred stock. And we'll go through an example. APNP issues 4 million of its $1 per value common shares and 2 million of its $5 par value preferred shares for $100 million. So we have common shares plus preferred shares for $100 million is what we have. And we have 4 million of common shares and 2 million of preferred shares. And we have to allocate this $100 million between common shares and preferred shares. Today's issue of the Wall Street Journal lists APNP's common shares at $10 per share. So this one is, we know, is $10 per share. So now we know the value of this one, right? And we know the total, so then what we assign to preferred stock will be the plug. So let's go through that. Well, first, we know we received cash for $100 million, so we're going to debit cash for $100 million. That's the first thing. Now the issue is, what are we going to credit, right? How are we going to assign the values to the common stock and the preferred stock? Let's do the common stock first because we actually know what value that holds. So we're told we have 4 million shares that we issued of the common stock, and the value of that is $10 per share. So in total, we issued $40 million worth of common shares. So the way we record that $40 million is we're going to credit common stock for the number of shares, the 4 million shares, times their par value, which is $1. So we're going to credit $4 million to common stock. And then we know the total is 40. So the remaining part is going to be recorded to paid in capital in excess of par for common stock for $36. Okay, so then now out of the $100, we've already accounted for 40, which means the remaining 60 is going to be allocated to the preferred stock. And the way we're going to do that is we're going to credit preferred stock. The number of shares of preferred stock that was sold was 2 million. We're told it's a $5 par value, so we're going to credit the preferred stock account for $10 million, and then the rest, the remaining portion of the 60, right, the $50 million that's left, is going to go paid in capital excess of par preferred for $50. So that's how we allocate that entry. Now, let's just say we have stock for a service. It's pretty much very similar. On June 5th, 600 shares of $15 par value common stock is issued for $12,000 of organizing work. Well, the value that we have assigned to this service is $12,000. So we're gonna, if we hired somebody to organize our office, it would be an expense, right? We would debit organization expense. So here we're going to do the same thing. Think of it as if we hired a law firm and they did $12,000 worth of legal work, we would debit legal expense. So just when you're issuing stock for a non-cash asset, it doesn't necessarily mean it's a balance sheet asset. It's just something, you know, that we have received in exchange for that stock. That's not cash. So we're going to debit organization costs, organization expenses, for $12,000. We're going to credit common stock for, we gave them 600 shares and they're valued at $15 par value. So we're going to take 600 times 15 is, we're going to credit common stock for 9,000, and then the remaining will go to goes to paid in capital in excess of par value common stock for the remaining, which is $3,000. Now, oftentimes when we issue shares, there's costs that are involved with that process, some administrative costs, some legal costs. And so let's see what we do with those costs. Duolingo sold 4,466,000 shares of its 0.0001 par common stock. When it says par common stock, it means par value. Par value common stock at $102 per share. They received net proceeds from the public offering of $426,192,000 after deducting $500,000 of underwriting discounts and commissions and other offering expenses. So what is their entry to record the sale? We received cash for this much, for this $426,192,000. So we're going to debit cash. That's the cash that we received. Okay. And then we have to assign a value to the stock that we've issued. And what do we do with this $500,000 of costs that were associated with selling these shares? Well, the rule is that we actually we do not record an expense for that item. Okay, when we're doing share issue costs, we just reduce the value of the paid-in capital. And let's go through it. So we know we received this $426 million, right, in cash. Our common stock, we're going to credit common stock for the number of shares that we sold multiplied by its par value, and that equals $447. And then the remaining amount, it's a plug, goes to paid-in capital in excess of par. It's just the remaining amount. We do not book any sort of expenses. We just reduce our equity section for those costs when it is share issue costs. Let's go through a concept check. Beamer Company issued 50,000 shares of 1 cent par value common stock for $230,000. Let's go through the transaction of how this would be recorded. One is we receive cash, $230,000, so we debit cash, $230,000. Then we record the common stock for its par value. So we take the number of shares sold times its par value, which is $500. So that's credit common stock $500. And then the remaining amount to make the journal entry balance is going to be paid-in capital excess of par for $229,500. So let's look at the question. Which of the following will Beamer Company record as part of the journal entry for this transaction? And we go through A, B, C, and D and see that D is the one that fits. Credit to common stock for $500.